Question 1. Policy management. Which of the following statements accurately describes the grace period provision in a term life insurance policy? A. The grace period is the time during which the policyholder can pay their premium without penalty and the policy remains in force. B. The grace period allows the insurance company to refuse payment if the insured dies within this time frame. C. The grace period is a contractual obligation that the policyholder must meet to maintain their coverage. D. The grace period automatically extends the policy's death benefit beyond the contract expiration date. Answer A. Explanation. In Vermont, as in many states, a grace period provision allows policyholders to pay overdue premiums without penalty and ensures that the insurance coverage remains active during this period. According to the Vermont Department of Financial Regulation, the grace period typically lasts for 30 days, during which the policy remains in force even if the premium is unpaid. If the insured dies during the grace period, the insurer must pay the death benefit, subtracting any overdue premium. Option B is incorrect because the insurer cannot refuse the claim solely because the premium was unpaid if the insured dies within the grace period. Option C is misleading. While paying premiums is a contractual obligation, the grace period provides an opportunity to fulfill this obligation without penalty. Option D is false as the grace period does not extend the coverage period of the policy beyond its original expiration date. Question 2. Underwriting process. Which of the following factors is least likely to be considered during the underwriting process for a term life insurance policy? A. The applicant's occupation and associated risks. B. The applicant's personal and family medical history. C. The applicant's financial status and credit score. D. The applicant's lifestyle choices, such as smoking or drinking. Answer. C. Explanation. While an applicant's financial status can be relevant in some contexts, it is not typically a primary focus during the underwriting process. For term life insurance, underwriting mainly assesses risks associated with the applicant's health, lifestyle, and occupation. Option A is incorrect because occupations with higher risks like construction or aviation are crucial for assessing the risk profile. Option B is essential as the medical history directly influences the likelihood of claims. Option D is also a critical factor since lifestyle choices significantly affect mortality risk and can lead to higher premiums. In Vermont, underwriters must adhere to guidelines established by the National Association of Insurance Commissioners (NAIC) to ensure fair practices and prevent discrimination based on non-relevant factors. Question 3. Scenario-based question. Mr. Thompson, a 40-year-old father of two, is considering purchasing a term life insurance policy. He is in good health but has a history of smoking, which he quit 6 months ago. What should Mr. Thompson consider when applying for the policy? A. He should expect higher premiums due to his smoking history even if he has quit. B. He can apply for a lower premium as he is no longer a smoker. C. He should not disclose his past smoking history on the application. D. He should consider only renewable term insurance as it offers more benefits for smokers. Answer A. Explanation. Mr. Thompson should be aware that, although he has quit smoking, insurers typically consider the applicant's smoking history within the last year when determining premiums. Most companies classify applicants as smokers for a minimum of 12 months after cessation. Therefore, he should expect higher premiums until he meets the non-smoker status for the required duration, which varies by insurer. Option B is incorrect. While he has quit, he may still be categorized as a smoker at this time. Option C is unethical and potentially illegal, or failing to disclose relevant health history could lead to policy rescission or denial of claims later. Option D is misleading. While renewable term insurance may offer certain benefits, it does not specifically cater to applicants with a smoking history. In Vermont, ethical considerations in underwriting and policy applications are guided by state regulations, which require full disclosure of health history and lifestyle choices to ensure fair underwriting practices. Question 4. Claims process. In the event of a policyholder's death, what is the first step that the beneficiary should take in the claims process for a term life insurance policy? A. Submit a claim form to the insurance company. B. Obtain a copy of the policyholder's death certificate. C. Contact the insurance agent who sold the policy. D. Wait for the insurance company to contact them. Answer B. Explanation. The first step a beneficiary should take is to obtain a copy of the policyholder's death certificate. This document is a legal requirement for initiating the claims process. It serves as proof of death, which is essential for the insurance company to process the claim. Option A is incorrect as claim forms are typically submitted after the death certificate is obtained. Option C can be helpful, but it is not the first step of contacting the agent should follow the procurement of necessary documents. Option D is misleading and the beneficiary should proactively initiate the claims process rather than wait for the insurer to act. In Vermont, the claims process is governed by both state regulations and the terms outlined in the insurance policy, which mandates timely notification of claims. Question 5. Problem-solving skills. An insurance agent is reviewing Mr. Jenkins' application for term life insurance. He notes that Mr. Jenkins has a significant history of high blood pressure but claims it is well managed. What should the agent do next? A. Approve the application without further consideration due to Mr. Jenkins' reassurance. B. Request additional medical documentation to assess the control of Mr. Jenkins' condition. C. Recommend that Mr. Jenkins apply for a higher coverage amount to offset the risk. D. Inform Mr. Jenkins that his application will likely be denied due to his history. Answer. B. Explanation. The insurance agent should request additional medical documentation to evaluate Mr. Jenkins' health condition accurately. High blood pressure can significantly impact underwriting decisions, and the insurer needs to assess the risk involved. Proper due diligence is essential to ensure compliance with underwriting guidelines. Option is incorrect because it fails to consider the necessary assessment of health risks. Option C is inappropriate as recommending a higher coverage amount does not address the health concerns and could mislead the client. Option D is premature. The agent cannot predict the outcome without reviewing the complete medical information. In Vermont, underwriting practices require agents to gather sufficient information to make informed decisions based on each applicant's specific health conditions and risk factors. Question 6. Term life insurance specifics. Which of the following best describes a decreasing term life insurance policy? A. A policy that provides a fixed death benefit throughout the term of coverage. B. A policy where the death benefit decreases over time, typically aligned with the financial obligation. C. A policy that allows the insured to convert to whole life insurance at the end of the term. D. A policy that offers increasing premiums for level coverage over the policy term. Answer. B. Explanation. A decreasing term life insurance policy is designed to provide a death benefit that decreases over time, which often correlates with financial obligations like a mortgage. This type of policy is suitable for individuals whose financial responsibilities diminish as they age. Option A is incorrect as it describes a level term policy rather than a decreasing one. Option C is not accurate. Conversion options are typically associated with other types of term policies. Option D misrepresents the nature of decreasing term policies, which do not feature increasing premiums. Vermont regulations dictate clear guidelines for the design and function of different term life insurance products, emphasizing consumer understanding of the specific features. Question 7. Fundamental concepts of life insurance. What is the primary purpose of term life insurance? A. To provide lifelong coverage and accumulate cash value. B. To offer a death benefit to beneficiaries in the event of the policyholder's death during the term. C. To serve as a savings plan for retirement while providing a death benefit. D. To ensure the policyholder's medical expenses are covered in case of serious illness. Answer. B. Explanation. The primary purpose of term life insurance is to provide a death benefit to the beneficiaries if the insured dies during the policy term. Term life insurance is designed to meet temporary financial needs, making it suitable for individuals who seek affordable coverage without the investment component associated with whole life insurance. Option A is incorrect because that describes whole life insurance. Option C is misleading. Term life insurance does not accumulate cash value. Option D inaccurately represents the purpose of term life insurance, which does not cover medical expenses. Vermont life insurance regulations emphasize that term policies focus on providing financial protection rather than investment opportunities. Question 8. Practical applications of life insurance. Which of the following best illustrates how term life insurance can play a role in estate planning? A. Using term life insurance to replace lost income during retirement. B. Setting up a term life insurance policy to pay off debts, ensuring heirs receive the remaining estate intact. C. Relying on term life insurance for long-term investment growth. D. Purchasing term life insurance to cover potential future medical costs. Answer. B. Explanation. Term life insurance can be a vital tool in estate planning by providing funds to pay off debts, such as mortgages or personal loans, ensuring that the heirs inherit the estate free of financial burdens. This approach facilitates the smooth transfer of assets and minimizes the impact of debt on the estate. Option A does not relate to estate planning, but rather focuses on income replacement, which is more relevant for disability coverage. Option C is misleading. A term life insurance does not offer investment growth. Option D inaccurately implies that term life insurance is meant for medical costs, which is not its purpose. In Vermont, effective estate planning often incorporates life insurance to address financial liabilities and protect the interests of beneficiaries. Question 9. Emerging trends and issues. With the rise of InsurTech, what potential impact does technology have on the underwriting process of term life insurance? A. It eliminates the need for any health-related questions on the application. B. It speeds up the underwriting process through data analytics and machine learning. C. It allows insurers to charge low premiums without evaluating risk factors. D. It reduces the importance of traditional underwriting guidelines established by state regulators. Answer: B. Explanation. Technology, particularly through data analytics and machine learning, has the potential to significantly speed up the underwriting process for term life insurance. Insurers can analyze vast amounts of data quickly to make more informed decisions, thereby enhancing efficiency and improving customer experience. Option is incorrect. Health-related questions remain important, even with advanced technology. Option C misrepresents the purpose of technology. It does not eliminate risk assessment. Option D is misleading. While technology can enhance underwriting, it does not negate established guidelines and regulations. In Vermont, insurers must adhere to regulations while incorporating technological advancements to ensure fair practices in underwriting. Question 10. Marketing and sales techniques. When approaching a potential client for term life insurance, which strategy should an agent prioritize to effectively address the client's needs? A. Focus on promoting the lowest premium available in the market. B. Emphasize the policy features that align with the client's financial responsibilities and future goals. C. Highlight the agent's sales achievements to establish credibility. D. Discuss the complexities of term life insurance in detail to showcase expertise. Answer: B. Explanation. An effective agent should emphasize the features of the policy that align with the client's specific financial responsibilities and future goals. Understanding and addressing the client's needs fosters a stronger client-agent relationship and demonstrates a commitment to providing suitable solutions. Option A is incorrect. Focusing solely on price may overlook the policy's overall value. Option C does not prioritize the client's needs and may come across as self-serving. Option D can overwhelm clients. Agents should communicate in a way that is clear and relevant to the client's situation. Vermont marketing regulations encourage agents to prioritize client needs and ethical selling practices, emphasizing the importance of aligning products with client objectives. Question 11. Term life insurance specifics. Which of the following is a key difference between level term and decreasing term life insurance policies? A. Level term insurance provides a higher death benefit than decreasing term insurance. B. Decreasing term insurance has premiums that remain constant throughout the policy term. C. Level term insurance offers a death benefit that remains unchanged, while decreasing term insurance provides a death benefit that reduces over time. D. Decreasing term insurance does not have a conversion option to permanent insurance. Answer: C. Explanation. The primary distinction between level term and decreasing term life insurance is that level term insurance maintains a fixed death benefit throughout the policy duration, while decreasing term insurance features a death benefit that declines over time, often aligned with financial obligations like a mortgage. Option A is incorrect. The death benefit amount varies based on policy design rather than type. Option B is misleading. Decreasing term policies typically have premiums that may vary based on the insurer's pricing strategy. Option D is incorrect. Many decreasing term policies do offer conversion options, though specifics may vary by insurer. In Vermont, regulations ensure that consumers understand the differences in policy features and benefits when selecting life insurance products. Question 12. Regulatory bodies and their functions. Which of the following functions is primarily carried out by the Vermont Department of Financial Regulation concerning life insurance? A. Setting premium rates for all life insurance policies sold in Vermont. B. Licensing insurance agents and monitoring their compliance with state regulations. C. Creating life insurance policies for consumers in the state. D. Guaranteeing the payment of all life insurance claims regardless of circumstances. Answer: B. Explanation. The Vermont Department of Financial Regulation is responsible for licensing insurance agents and ensuring they adhere to state laws and regulations. This oversight protects consumers and maintains industry standards. Option is incorrect. While regulators oversee rate filings, they do not set premiums directly. Option C is misleading. The department does not create policies, it regulates insurers who do. Option D is incorrect. The department does not guarantee payments for claims, as this depends on policy terms and conditions. In Vermont, regulatory bodies play a crucial role in maintaining the integrity of the insurance marketplace, ensuring agents operate ethically and transparently. Question 13. Underwriting process. In assessing an applicant's lifestyle choices, which of the following would most likely lead to a higher premium in the underwriting process for term life insurance? A. Participation in regular physical activity and a healthy diet. B. A profession as a firefighter with a history of health issues. C. Occasional alcohol consumption within legal limits. D. A family history of longevity with minimal health concerns. Answer. B. Explanation. A profession as a firefighter, particularly with a history of health issues, would likely lead to a higher premium due to the increased risk associated with both the occupation and personal health factors. Underwriters assess various risks, and occupations with higher hazards are scrutinized more closely. Option A would typically lower the risk assessment, leading to a potentially lower premium. Option C may not significantly impact premiums if within legal limits and with no related health issues. Option D usually indicates low risk, possibly leading to lower premiums, as a family history of longevity is generally favorable. In Vermont, underwriting guidelines are designed to consider various risk factors, helping insurers set appropriate premiums based on an applicant's profile. Question 14. Claims process. After a claim is filed for a term life insurance policy, how long does an insurer typically have to process the claim before it is considered overdue under Vermont law? A. 30 days. B. 60 days. C. 90 days. D. 120 days. Answer. C. Explanation. Under Vermont law, insurers generally have 90 days to process a life insurance claim after receiving all necessary documentation, including the death certificate. If the claim is not processed within this time frame, it may be considered overdue, and the insurer could face penalties or additional obligations. Option A and Option B are incorrect, as they do not reflect the typical statutory requirement. Option D extends beyond the typical processing time frame stipulated in state regulations. Understanding these timelines is critical for beneficiaries to ensure they follow up appropriately and advocate for timely claims processing. Question 15. Policy management. If a term life insurance policyholder decides to stop paying premiums, what is the most common outcome regarding the policy? A. The policy will automatically convert to a whole life policy. B. The policy will lapse and coverage will terminate. C. The insurer will continue coverage for an additional year without payment. D. The policy will remain in force until the next premium is due. Answer. B. Explanation. If a policyholder stops paying premiums on a term life insurance policy, the policy typically lapses, leading to the termination of coverage. Term life insurance policies do not accumulate cash value, so non-payment results in loss of coverage rather than conversion or grace periods as seen in whole life policies. Option is incorrect. Policies do not automatically convert without specific terms outlined by the insurer. Option C is misleading. There is usually no grace period beyond the specified time frame for payment. Option D is inaccurate, as policies do not continue without payment. Vermont regulations emphasize clarity in policy terms, ensuring that consumers are aware of the implications of non-payment. Question 16. Practical applications of life insurance. Which scenario best illustrates the importance of term life insurance for young families? A. A young couple planning for retirement with investments in the stock market. B. A newly married couple expecting their first child, wanting to secure their family's financial future in case of an untimely death. C. A single professional investing in real estate without dependents. D. An older couple revising their estate plans to include trusts. Answer. B. Explanation. A young couple expecting their first child exemplifies the importance of term life insurance in securing their family's financial future. In the event of an untimely death, a term life policy can provide the necessary funds for dependents, covering expenses such as child rearing and debts. Option A is focused on retirement and does not address immediate family needs. Option C highlights a scenario without dependents where life insurance may not be as critical. Option D is more relevant for estate planning and does not involve term life insurance's primary purpose. Vermont regulations encourage the use of life insurance as a financial safety net for families, particularly those with young children. Question 17. Emerging trends and issues. How has the increasing integration of technology, InsurTech, influenced consumer choice in purchasing term life insurance? A. Consumers are now obligated to purchase insurance solely through online platforms. B. Technology has made comparing policy features and premiums more accessible and transparent for consumers. C. InsurTech has eliminated the need for human agents, leaving consumers without guidance. D. Technology has reduced the amount of information available to consumers when selecting policies. Answer: B. Explanation. The integration of InsurTech has made it significantly easier for consumers to compare policy features, premiums, and providers, enhancing transparency in the decision-making process. This access allows consumers to make more informed choices regarding their term life insurance needs. Option is incorrect. Consumers still have the option to purchase insurance through traditional agents. Option C is misleading. While technology facilitates online purchases, many consumers still value the guidance of human agents. Option D is incorrect. Technology typically increases the amount of accessible information. In Vermont, the rise of InsurTech is reshaping how consumers engage with life insurance, emphasizing the importance of informed decision-making. Question 18. Critical thinking abilities. During a needs assessment, how should an insurance agent prioritize the discussions regarding life insurance coverage with a client who has young children and a mortgage? A. Focus solely on the client's health history to determine eligibility for coverage. B. Discuss the impact of coverage on future education costs for the children. C. Emphasize the importance of coverage to pay off the mortgage in the event of the client's untimely death. D. Recommend the highest possible coverage amount without discussing the client's budget. Answer: C. Explanation. In this scenario, the agent should emphasize the importance of life insurance coverage to ensure that the mortgage can be paid off in the event of the client's untimely death. This approach protects the family's home and provides financial stability for dependents. Option A is incorrect, as health history, while relevant, should not be the sole focus in this context. Option B is important but secondary to immediate financial obligations like the mortgage. Option D is inappropriate as it disregards the client's financial situation and budget considerations. In Vermont, agents are encouraged to adopt a needs-based approach, ensuring that discussions are tailored to the client's specific circumstances and financial responsibilities. Question 19. Policy management. A policyholder wants to convert their term life insurance policy to a permanent policy before the term expires. Which of the following must they typically do? A. Submit a request without providing any evidence of insurability. B. Wait until the end of the policy term to apply for conversion. C. Provide evidence of insurability and complete a conversion application. D. Pay the full premium of the new permanent policy upfront. Answer: C. Explanation. To convert a term life insurance policy to a permanent policy before the term expires, the policyholder typically needs to provide evidence of insurability and complete a conversion application. Many insurers allow for conversion without the need for medical underwriting, depending on the terms of the original policy. This feature provides an opportunity for policyholders to obtain permanent coverage while avoiding potential increases in premiums due to changes in health status. Option is incorrect. While some policies may allow for conversion without evidence of insurability, this is not universally applicable, and an application process is usually required. Option B is misleading. Policyholders do not need to wait until the end of the term. They could convert earlier if allowed by the policy. Option D is incorrect. While premiums for permanent policies are generally higher, policyholders typically have the option to pay premiums on a schedule rather than in full upfront. In Vermont, insurance regulations emphasize the importance of clear communication regarding policy conversion options, helping consumers understand their rights and available choices. Question 20. Risk assessment. What is the primary factor that term life insurance underwriters consider when assessing the risk of an applicant? A. The applicant's family history of diseases. B. The applicant's income level. C. The applicant's personal hobbies and interests. D. The applicant's geographical location. Answer A. Explanation. The primary factor considered by underwriters when assessing the risk of an applicant is the family history of diseases. A family history of certain illnesses can indicate potential health risks for the applicant, influencing the underwriting decision and premium rates. Option B is less relevant, as income level typically impacts the amount of coverage the applicant can afford rather than their insurability. Option C can be a factor if hobbies involve high risk, e.g. skydiving, but it is not the primary consideration. Option D may affect premiums due to location-specific risk factors but is secondary to personal and familial health history. Understanding these risk factors is essential for both consumers and agents in Vermont to navigate the underwriting process effectively. Question 21. Benefits of term life insurance. Which of the following is a significant advantage of purchasing a term life insurance policy? A. It builds cash value over time. B. It typically offers lower initial premiums compared to permanent life insurance. C. It provides lifelong coverage without the need for renewal. D. It guarantees a death benefit payout regardless of circumstances. Answer: B. Explanation. One of the main advantages of term life insurance is that it usually has lower initial premiums compared to permanent life insurance policies. This affordability makes it an attractive option for many individuals seeking coverage for a specific period, such as while raising children or paying off a mortgage. Option A is incorrect. Term life policies do not accumulate cash value. Option C is misleading. A term life insurance provides coverage only for a specified term and requires renewal or conversion for continued coverage. Option D is incorrect. Benefits are paid out only if the terms of the policy are met, such as in the case of a death occurring within the term. In Vermont, the affordability of term life insurance is often emphasized to help consumers secure necessary coverage for short to medium-term financial obligations. Question 22. Policy features. Which feature allows a term life insurance policyholder to extend coverage after the initial term ends? A. Renewable term option. B. Convertible term option. C. Adjustable premium feature. D. Waiver of premium rider. Answer A. Explanation. A renewable term option allows a policyholder to extend their coverage after the initial term ends, usually without having to provide evidence of insurability. This feature is beneficial for individuals who want to maintain their coverage despite potential changes in health status. Option B refers to the ability to convert to a permanent policy rather than extending the term. Option C involves modifying premium amounts but does not relate to extending the coverage period. Option D refers to a rider that waives premiums in the event of disability but does not provide coverage extension options. In Vermont, understanding these features helps consumers make informed decisions about their insurance needs as life circumstances change. Question 23. Coverage limitations. What is a common limitation of term life insurance policies regarding death benefits? A. Death benefits may not be paid if the insured commits suicide within the first 2 years. B. Death benefits are not available for accidental deaths. C. Death benefits are only paid if the insured has a specific cause of death listed in the policy. D. Death benefits are contingent on the insured's age at the time of application. Answer A. Explanation. A common limitation in term life insurance policies is that death benefits may not be paid if the insured commits suicide within the first 2 years of the policy. This is known as the suicide cause, which is standard in many life insurance contracts to prevent moral hazard. Option B is incorrect. In most term policies do cover accidental deaths provided the policy is active. Option C is misleading and death benefits are generally not limited to specific causes unless explicitly stated in the policy. Option D is inaccurate. Benefits are not typically contingent on the insured's age at application, but rather on policy terms and conditions. In Vermont, consumers should be aware of these limitations to ensure they choose policies that align with their needs and circumstances. Question 24. Financial considerations. Which of the following scenarios would likely necessitate the purchase of additional term life insurance coverage? A. A retiree with no dependents. B. A young professional who just purchased a home and started a family. C. A single individual with stable financial investments. D. A couple planning to downsize their living situation. Answer B. Explanation. A young professional who has recently purchased a home and started a family may need additional term life insurance coverage to protect their new financial responsibilities and ensure their family is secure in the event of an unexpected death. This coverage would help cover mortgage payments and living expenses for dependents. Option A is incorrect. A retiree with no dependents may not require additional coverage. Option C does not indicate a need for additional coverage as the individual has no dependents to protect. Option D involves downsizing, which may not increase financial obligations necessitating more insurance. In Vermont, recognizing changing life circumstances is crucial for consumers to maintain adequate insurance coverage. Question 25. Consumer education. What is a critical element of consumer education regarding term life insurance policies that agents should emphasize? A. The complexity of underwriting processes can lead to delayed coverage. B. All policies automatically renew without any action from the policyholder. C. Policyholders can borrow against the cash value at any time. D. Understanding the difference between term and permanent life insurance is essential for informed decisions. Answer D. Explanation. Agents should emphasize the importance of understanding the differences between term and permanent life insurance policies. This knowledge is essential for consumers to make informed decisions based on their specific financial needs and goals. Option is misleading, and while underwriting can cause delays, it is not the most critical consumer education element. Option B is incorrect. Not all policies renew automatically. Some require action or may be subject to changes in terms. Option C is inaccurate. Term policies do not have cash value that can be borrowed against. In Vermont, consumer education is vital for fostering informed decision-making in the insurance marketplace, enabling individuals to choose the right coverage for their circumstances. Question 26. Contestability period. During which period can an insurance company contest a claim based on misrepresentation or concealment of information provided by the policyholder? A. The first year of the policy. B. The first 2 years of the policy. C. The entire term of the policy. D. After the policy has been in effect for 5 years. Answer B. Explanation. The contestability period is typically the first 2 years of a life insurance policy, during which the insurer has the right to investigate and contest a claim based on misrepresentation or concealment of material facts by the policyholder. After this period, the insurer generally cannot deny a claim based on such reasons, provided the premiums have been paid and the policy is in force. Option A is incorrect. While the first year is critical, the contestability period extends to the second year. Option C is misleading, and claims can only be contested based on certain conditions within the contestability period. Option D is incorrect. The insurer loses the right to contest the claim based on misrepresentation after the 2-year period. In Vermont, understanding the contestability period is essential for consumers to be aware of their rights and obligations during the early phase of their policy. Question 27. Claims process. What documentation is typically required when filing a claim for a term life insurance policy? A. The policyholder's bank statements and tax returns. B. A copy of the death certificate and the insurance policy. C. The beneficiary's health records and personal identification. D. A statement from the insured's employer regarding salary history. Answer B. Explanation. When filing a claim for a term life insurance policy, the primary documentation required usually includes a copy of the death certificate and the insurance policy. This documentation confirms the occurrence of the death and the validity of the policy in effect at that time. Option A is incorrect. Bank statements and tax returns are not typically required for a death claim. Option C is misleading, and the beneficiary's health records are relevant to the claim process for the deceased. Option D is incorrect. The salary history is not pertinent to the determination of life insurance claims. In Vermont, understanding the claims process and required documentation helps beneficiaries ensure that claims are filed promptly and accurately. Question 20. Underwriting guidelines. Which factor is least likely to be considered during the underwriting process for a term life insurance application? A. The applicant's medical history. B. The applicant's credit score. C. The applicant's lifestyle choices. D. The applicant's family history of health conditions. Answer B. Explanation. While underwriting considers various factors to assess risk, the applicant's credit score is generally the least likely factor influencing the decision for term life insurance. Underwriting primarily focuses on health-related information such as medical history, lifestyle choices like smoking, and family history of health conditions that may impact mortality risk. Option is incorrect. Medical history is a critical factor in underwriting decisions. Option C is relevant, as lifestyle choices can significantly affect mortality and thus insurability. Option D is also crucial, since family health history can indicate potential health risks. In Vermont, recognizing the importance of underwriting factors aids consumers in understanding how their applications are evaluated. Question 29. Policy provisions. Which of the following provisions in a term life insurance policy allows the policyholder to stop paying premiums without losing coverage under certain conditions? A. Waiver of premium rider. B. Guaranteed insurability option. C. Extended term provision. D. Non-forfeiture clause. Answer A. Explanation. The The waiver of premium rider allows the policyholder to stop paying premiums without losing coverage if they become disabled and are unable to work. This rider ensures that coverage continues during periods of financial hardship due to health issues. Option B refers to an option that allows policyholders to purchase additional coverage without evidence of insurability but does not relate to premium payments. Option C is incorrect. If the extended term provision allows for the conversion of a policy's cash value into term insurance but does not stop premium payments. Option D is misleading. A non-forfeiture clause typically relates to permanent insurance policies and not specifically to the waiving of premiums in term policies. In Vermont, understanding riders and provisions in insurance policies can enhance consumer protection and awareness. Question 30. Consumer protections. What is one of the primary consumer protections related to life insurance policies in Vermont? A mandatory review of all policies by a state regulatory body before sale. B. Guaranteed refunds for any premiums paid within the first year. C. A grace period during which premium payments can be made without coverage lapsing. D. Automatic approval of all applications submitted by consumers. Answer C. Explanation. One of the primary consumer protections related to life insurance policies in Vermont is the provision for a grace period. This is a specified time after the premium due date during which the policyholder can make their payment without the risk of losing coverage. Typically, the grace period lasts for 30 days, ensuring that policyholders do not inadvertently lapse their policies due to late payments. Option is incorrect. While regulations govern insurance sales, not all policies are reviewed by the state before sale. Option B is misleading. While some policies may offer certain guarantees, automatic refunds within the first year are not standard practice. Option D is incorrect. Applications can be denied based on underwriting criteria, and automatic approval is not a consumer right. In Vermont, understanding these consumer protections enables policyholders to manage their life insurance policies effectively.